Alrighty, welcome to another episode of Money Spoke. I'm your host, Casey Hull, co-founder of Money Spoke and certified financial planner. Today we're going to be doing a little exercise in budgeting, and we'll just call this sort of 101. There's a lot of resources out there for budgeting, and unfortunately it becomes a lot more difficult in real life. So I'm going to give you sort of a breakdown of how I think about it and sort of what you should be looking to do yourself to get a better handle on your budget. So I think really when looking at budgeting, there's a number of sort of big things that we want to take into account before we can really build out our budget. So the first is obviously looking at our income. This is obviously a big piece. Looking at what our deductions are. Oftentimes this can be found on your pay stub if you have access to it. And deductions can refer to a number of things. The first being, 401k contributions. If you have access to one, we can have taxes withhold in most cases, Social Security, tax or pay-in, and then also insurance if you are opted into your employer plan. If you're self-employed, these change a little bit, as none of them would most likely be withheld, and you should be working with a tax accountant to account for taxes, what you're supposed to be paying in for Social Security, and then you're probably paying for your own insurance as well. So in this example, let's just look at sort of the inflows to begin with, right? So let's say that you're getting paid bi-weekly, right? And on a bi-weekly basis, you are making $3,000 gross. I'll just put gross and the dollar sign. So this would be $6,000 a month, right? So $6K each month on a gross basis. Now, some of these deductions are going to be sort of coming out ahead of time. So let's say that, each paycheck, let's just put every 2 weeks. So every 2 weeks, let's say you're putting 10% into your 401k, and we'll change the color here just to show this as a deduction. So that would be $300 every 2 weeks, or $600 every month, each month. Right? Let's say for taxes that you're putting in roughly $600, or withholding $600 every 2 weeks, or $1,200 every month. $1,200 every month. Social Security tax, let's say, this is a positive and a negative. Social Security tax, let's just say, is $30 or $60 each month. And insurance, we'll say, is $50 or $100 each month. Right, so from this point, we can sort of say, before we get into our own expenses, what is my net take-home pay, right, after these initial deductions? So we'll go back to green here, and I'll just jump on the calculator, do a little math. 6,000 minus 1,200 minus 600 minus 60 minus 100 equals $4,040 a month. That's your take-home pay, right? So this is your net income after deductions, 401k contributions, etc. So what I would look to do now that I've sort of derived at this number is create a spreadsheet, right? So I know that my net income is $4,040 a month, right? What are my expenses? What are my line item expenses each month, right? So these are obviously going to change. It helps to start with the fixed expenses, right? So let's just say rent is $1,200 a month. Say we have car payments which equal $200 a month. Let's say that our groceries equal $400 a month. Let's say eating out is $200 a month. Entertainment. Entertainment is another $300. Let's say student loans. Is $400, right? So these are sort of the fixed expenses, right? Now this is sort of variable. This will change, this will change, this will change. We have 1, 2, 3 sort of line items that are absolutely fixed, right? So it helps to tally these up and total them. So if I jump on my calculator again really quickly, 1200 plus 200 plus 400 plus 200 plus 300 plus 400 equals $2,700. Is my total monthly expense. And we have monthly income, net income of $4,040. Right, so we just subtract one from the other, and we are left with $1,340 after all my expenses, after all my deductions, right? So this is sort of money that I now have to decide what I want to do with, right? So we prioritize sort of your saving strategy into a number of buckets, but we prioritize them as such, right? So number one would be having an adequately built emergency fund. Number two would be, paying down bad debt. And what I mean by bad debt is high interest rate debt. In this particular case, we do anything that's greater than 5% is where we want to focus. Student loans are often coming in below this, but if you have student loans that are higher, we probably want to focus on knocking these out. Number three would be tax-deferred savings, or in this particular example, 401k. This could be IRA or SEP IRA for other people, depending on your status. Four would sort of be other goal savings. And then five would just be brokerage, regular investments as sort of a supplement to retirement savings. So the way that I sort of look at these or the way that I try to attack them is sort of in a waterfall strategy, right? So if we're looking at your 911 fund, for example, first of all, what is an appropriate emergency fund, right? So generally speaking, we say that is 6 months of essential expenses. Now, this can change if you have a family, you have other people depending on you, you're the primary breadwinner, your job is volatile, whatever it may be. This is obviously just meant to be a rule of thumb, right? So 6 months essential, and that's sort of the key word here, right? So when looking at these fixed expenses, I would consider rent to be essential, your car payments to be essential, your groceries to be essential, although we could probably, we could vary this based on if we're eating canned food or if we're buying all organic, etc. I would not consider eating out or entertainment to be essential, but I would say student loans are, right? So when we total these up, our essential expenses each month equals the sum of those positions. So that would be about $1,400, $1,800, $1,900, $2,000, $2,200, right? So $2,200 is our essential monthly expenses, what we need to really live, right? Multiply this by 6. 2,200 times 6 equals 13,200. right? So I would look at this as being, so here's my emergency fund, 911. Let's say that I have a balance of $0 today, right? So I would look at this as being sort of the first bucket, right? Now, we'll just illustrate this here with just a poor figurative drawing of a bucket. Let's say that you don't have any bad debt. Let's say that the next step would be, since you're already saving into your 401k, referenced by the deductions here, that you're saving for a home, right? And you have $0 today, and you need, let's say, $100,000 in 10 years, right? And we already know what our emergency fund is, so $13,200 is our need here. And then let's say that the next would just be additional savings, right? So we can sort of just put that as the next bucket down. But let me put in a bucket for the home down payment. So when we're looking at what you're taking home each month, $13,400, right? So what we're going to do is we're going to take that $13,400 and we're going to apply it to our emergency fund, right? So that's going to sort of start to fill up the bucket here, right? So this would go to 1,340. So we're getting there, right? This is going to take about roughly 1 year to fill this bucket up, right? Until it's all the way at the top. From that point, we would overflow to the next bucket, right? And then each additional month's savings would be going towards a dedicated home down payment. So the important thing about an emergency fund, in the event of an emergency, obviously, you want to be able to give yourself some runway to get back on your feet. That's why we prioritize this as being number one. But the illustration is really just meant to show how this is supposed to be a waterfall, right? Once this is completed, you no longer have to save any money to it. We can start focusing on other goals, such as a home down payment, increasing our 401k contributions, saving for supplemental retirement savings down here. So that's really kind of how I think about it on a broad level. Now, there's some really good resources out there for you that you're probably going to want to take some time looking at. I think for me, tracking expenses becomes one of the hardest things. So if you're looking at Clarity, right? Clarity is this really great app that tracks your expenses over time. There's a number of them out there. I tend to prefer Clarity. You link your accounts. It sort of lets you know what you're spending each and every month. That way you can make sort of this part of your spreadsheet a little bit more clear and really focus in on what is my take-home pay. As well as being able to dive in and say, hey, you know what? I ate out way too much last month. This is above my normal habit. I'm not including this because it was rare. I had family and friends in town, whatever it may be. It helps you be able to dive in and really prioritize your saving strategy here. Well, that'll do it for a simple budget exercise. Let us know if you have questions, as always, by going to mymoneyspoke.com. Feel free to shoot us an email. In addition, we've included some resources to help you figure out your emergency fund and what that should look like. You simply plug in your expenses and go from there. Thank you and have a great day.